As we all know, raising funds for mining project is like pulling a needle out of a haystack. One of the key things is the valuation at the present stage.
Hmm.
We've been able to bootstrap directly in-house, but we are at the stage whereas we are aiming to obtain a 43101, excluding resource estimation. How does that factor into valuation at present time? We own the assets. We own the rights to the minerals. We have all licensing with the federal government, and we are looking for, well, we have some private placements coming in, but we still have to back it up with valuation. And this will tie my next question into Mr. Andrew. It won't be a question, actually. It will be, how does Keops Group assist with bridging the gap for greenfield projects? Thank you.
Sure. Okay, Abdul, thank you for your question. As I mentioned, the valuation of an ore resource or a mine depends on the stage of development and the milestones. It sounds like you have achieved the first milestones, which is owning the asset and obtaining the licenses. The next milestone would be firming the resource amount, the size of the resource, the drilling program, setting up the data room. Investors will want to see the data room. Investors will most probably want to go and see the site, a site visit. So the resource valuation in size is important. Going forward, the mine plan, has the mine plan been completed? And then costing the mine plan, the infrastructure costs, the CapEx development, and the operation costs. And then the resource, the economic analysis of the resource going forward for 25 years. Where is the price of the lithium going? Where's the lithium going to be in 25 years? Interesting. It's a heroic question, heroic answer. They're the stages. In putting together, in firming up the resource, the JORC, the Joint Ore Resource Committee approach of the Australasian Institute of Mining and Metallurgy can help. But they're the types of approaches that I go through. Then to come back now to getting investment into your property, you have to make assumptions of the value, the amount of the ore, the price of the ore, and the ore costs. But you are early stage, so what discount rate would you need to come up with a value today for an investment? That's where the various discount rates at each milestone come into place. Some investors may, and it depends on the investor. If it's a strategic investor who wants your product, he may be happy to discount your model, discounted cash flow model at 20%. Others may want to use 40%. As you go forward and achieve your milestones, your discount rate is going to reduce from 40 to 30 to 20 to 12 or so. So that's the process. Okay, and it really depends on who's out there to invest. Obviously, lithium is an important, a critical mineral, and you could find a strategic investor who may be interested in the product. You've got sovereign risk, but that can be covered by MEGA, Multi-Investment Guarantee Authority from the World Bank. You got insurance for that. That's the other thing. What are the risks? How can you box each of those risks? I hope that helps, Abdul.
Excellent. Thank you. Thank you very much. Perfect.
Thank you, Sam. And Andrew, would you like to explain a little bit how Keops can help, Abdul, please?
Sure, absolutely. Yeah, look, I mean, this is sort of a sweet spot for the sort of companies that come to us asking us for assistance. And we work with the whole team, including Marnie's aforementioned Les Shanza, who works with us as well. And the reality is, Abdul, that there's several classes of investor who might be interested in investing in your project and company. And they're basically early investors who like getting in quite early on a project so that they're in at the best price possible, even though there's more risk at an earlier stage. As Sam mentions, a strategic investor who may want your product down the track and who may have been locked out of projects by larger companies. So you can play that card in that early investors who either missed out on the company equity or project equity for offtake, they're good areas to look at, and that's sort of partially what we do. We put a group of people together who are interested, who we know fit into that category, but then also suppliers, right? So you'll need to drill it out. So there's an opportunity to work with supplier groups, drilling groups, who might be prepared to take a company stake or project equity stake in return for yeah, maybe not all of their services, but a useful portion of their services to defray your costs. And so rather than try to compete with people with much later stage projects and so on and so forth, who have a bit more defined runway of who they go and speak to, you're, as it were, looking for more sort of esoteric solutions in terms of people who haven't got in, who want to get in terms of early company investment, or off-takers, or suppliers who also are prepared to provide their services partially for shares. So there's, and that's basically what Keops does. It puts together these different, more complex solutions, rather than, as I say, other groups who are in Keops' space. And you know, if you've got a JORC resource and you're far more developed, you've got cash in the bank, so on and so forth, and you can just walk around to larger brokers and see who bites at it. Now that's still a potential for you, but at an earlier stage, it's more likely that a strategic or a supplier or a very early stage investor is more your line, and we put that together. And the other thing is, to some extent, it's a good thing, because you can cut a whole lot of people off your list, and you can be very focused, because your investment or your company will appeal to a very specific group of counterparties. So that's good in some way, because it'll save your time.